In this week's edition of the Business 7 Show, we are joined in studio by the Manager of Financial Stability at the Namibia Financial Institution Supervisory Authority to speak into some growth trends that were observed in the non-banking financial services sector. We are joined in studio by the Manager of Financial Stability at the Namibia Financial Institution Supervisory Authority, Mr. Barthomelos Katota. Thank you so much for making the time to avail yourself.
It's a pleasure.
The regulator NAMFISA recently released the quarterly quarterly bulletin for the second quarter of the year. Essentially, sum the bulletin up just to give an indication of what the main topics are that are covered.
Yeah, so basically in general, the quarterly update is aligned to the NAMFISA mandate. NAMFISA exists to supervise and regulate the non-banking financial institutions, and it boils down to financial, you have the pillar of the prudential mandate, which looks at the financial soundness, how healthy are these institutions, and then we have a component of financial crime and consumer protection. So in our reporting, in this quarterly report, so that is actually the kind of scope that is followed in terms of developments for the quarter during under review.
What is the main importance behind the bulletin?
So the main importance is actually to keep our stakeholders informed in terms of the new developments. So in the report, you will notice that it has two main sections. One is the industry developments, which then looks at the financial performance of these companies during the quarter. We look at their asset growth, basically the financials, how they performed in relation to the economy and so forth, their solvency, liquidity and all that. That is looking at the financial soundness, soundness of the institutions. And then the second component is, there's a component for supervisory developments. Under there, we report on activities around new changes to the law, legislations, directives, standard issues, complaint statistics. We also talk on registration, companies which were registered and deregistered. So this kind of information is important for your ordinary consumer, because as a consumer, you need to know, to be aware about what are the new laws, which companies are legally registered to do business, and which companies are no longer legal or registered with NAMFISA, because you find oftentimes that consumers fall victim to some of these deregistered companies, and they just take people's money and run. Yeah.
What are some of the major trends emanating out of this quarterly bulletin that you observed or that stood out for you significantly?
So I'll start off by maybe just painting the picture in terms of the size of the industry. Then you can have an appreciation in terms of the key trends. So during the quarter under review, the non-banking assets came in. It grew by 4%, 4.2%. That is on a quarterly basis compared to quarter on quarter, and then over 12% year on year. So we are looking at over 500 billion, just about 500 billion. That is the size of the asset. And the growth factors, is mainly driven by three industries, which predominantly account for 90% of the market. And in this case, we have your pension fund, we have your collective investment schemes, which is known as unit trust, and then we have your long-term insurance.
Yeah.
So these are the three top sectors, which being the largest in size, they are the movers and shakers in terms of driving the growth of the asset of the industry.
Yeah. Just in terms of that picture that you've painted, and this is somewhat of a topical issue that I want to bring in, is the issue of the the lenders. You're speaking now to these, or should I, for lack of a better term, the cash loans. What are the trends that you're seeing developing there? What are the growth trends that you've seen, and in terms also just in terms of the number of intermediaries, but also the growth in assets?
So for the term lenders, I would say the biggest growth is more in terms of new registrations. So the statistics predominantly, I think it's approaching 1,000, it's just above 1,000 in terms of active registered micro lenders. So there's a lot of appetite in terms of new registrations to join players to join the market. But in terms of disbursements, so naturally there's an element of recycling. And also you will notice that given that the ordinary consumers, they are under household pressure, I mean the balance sheets are under stress financially. So there's that effect. We have seen on the banking side, for example, the credit extension was predominantly below 3%. So you can see, so on this side, the consumers are also under financial distress, so that's why the growth is not so much significant as one would wish, because people are under significant pressure, and there's a lot of recycling. You know, you'll find that same consumers, so they are just taking the same revolving loans. You pay down, and then so the micro lenders, because it's a monthly trend, so they sort of tend to recycle some of these things. And also, I should also tell you that the regulators have also been very strict with the lenders in the space by introducing some of the close monitoring interventions to ensure that they over-lending without paying attention to affordability. So now PRISA went out to implement strict measures to enforce the compliance in terms of affordability. And that naturally also has contained that artificial growth, if you like, because growth must be healthy, not toxic.
Of course.
Because when you deduct someone's salary and leave them with a $20, so it's abuse. Of course.
We'll move back to the issue of the quarterly bulletin, but just to continue on this path of the term lenders, the growth in registered entities. Is this a cause for concern that we are seeing a large number of micro lenders now emanating?
So I think there are two faults. The positive side to that is because we know that a lot of these lenders, informally they are called shadow or unregistered. Most of them tend to operate illegally, and they are charging ridiculous rates. Some of them I had 40%, 50%. So for us, partly it's a blessing, because then the consumers who will be doing business with these lenders who are coming to light in our regulatory safety net, it's a positive for the consumer protection. So the concern is only when we have these lenders taking money, and they are not registered, and then the consumer comes to an officer and says, no, this person took my ID, took my what, or they over-deducted me when I settled. So then it becomes unfortunate, because there's nothing really much we can do, because this transaction happened outside the regulatory net. And also something I should mention to you is there's what you call money lender and micro lenders. So if someone is a micro lender, then by law they have to be registered with an officer, because they are charging the standard according to the Usury Act. But people who are charging below the Usury Act, so by law, at the moment, they are excluded from the safety net. So these are some of the issues around awareness.
Okay.
Yeah.
Okay. And then just in terms of, again, I'll circle back to the issue of the quarterly bulletin. In terms of, I know that there's a Micro Lending Act is being looked at the moment. How do you see it addressing this issue in terms of ensuring that there is borrowed control within the economy?
Okay, so the Micro Lending Act is one. I know it deals with some of the provisions to enforce affordability and so on.
Yes.
But the most important framework that the regulator is working on now is something we call TCF framework, treating customers fairly. So that will now then enforce the provisions in terms of how we assess risks, consumer risks, in terms of the space of whether it's all the sectors which an officer regulates, from pension, insurance, investments, medical aid. So the treating customers fairly framework will will help us enforce and improve our regulatory tools, how we assess risks to then deal with some of the issues on the back of this Micro-Lending Act.
Yeah. You've mentioned that there's been this growth in the number of intermediaries now, generally in the non-banking financial sector, but also in terms of assets that these institutions manage. On the part of NAMFISA, in terms of financial stability, your core responsibility, does it mean that with growth there comes there's an added problem in terms of properly regulating these entities from your end?
So at the moment, from an NAMFISA, maybe I must just put into perspective, financial stability, it speaks to what you call prudential side. Prudential, by prudential I mean financial soundness, because financial stability speaks to the balance sheet, whether the company has a strong balance sheet to be able to pay its debts and also to be able to stand against shocks, whether there is a crisis happening and you don't want the company to be wiped out, So from a financial stability perspective, normally what we do is there's a criteria that we look at to identify which companies are considered systemically important. If company A, for example, is classified as systemically important, it means if it fails, then it means its failure is likely to cause shock waves in the system. It's likely to affect other. There's that contagion, spillover effects.
Yeah.
So in terms of the question that you asked, I think that is more in terms of our capacity as an institution to manage resources. So at the moment we apply a principle called risk-based supervision. So it's a principle based on proportionality. So we identify these key players or institutions which has a lot of customers, and then we prioritize our resources on them. And then the others who are not so big in size, or they do not have so many clients, so it's a proportionality. We apply a proportionality principle. We prioritize depending on who has the highest number of clients, and also the assets under management, and then you also look at the risk profile of these institutions. For example, if company A has 10% of the market share and company B has 50%, obviously from where we sit, our priority is more to focus 80% of our resources to this big company and 20% or 10% or whatever of our resources to the small company. So that's how we prioritize, just to give you the picture.
Okay. That risk profile or matrix that you've shared, in terms of your observations, coming back now to the quarterly bulletin, are there any specific sectors that have shown themselves to present any risks at the moment?
Yeah, so in terms of so it's called the supervisory level of intervention. So that is the scale, the risk rating scale we use. It's from stage 1 up to stage 5. Stage 5 is actually the highest level in terms of risk. Stage 5 and 4, those are considered to be high risk. So for the quarter under review, so we have seen that on the two extremes, more than 60% of companies were green, that is stage 1, low risk.
Yeah. And
then stage 5, you had just below 10%. And the majority, 90% of these institutions are your micro lenders. So again, it comes back to size. So in terms of significance, they do not have so many clients, even though in numbers there are so many. Like I mentioned earlier, NAMFISA has more than 1,000 entities under registration, and more than 80% of that are micro lenders. But in terms of asset size, the 3 institutions are considered more important, because pension fund accounts for over 50% of the whole sector. And then your long-term and collective investment schemes, all 3 together account for 90%. So in terms of that risk rating of the ladder statistics, we are comfortable because more than 80% of the companies we regulate, they do not have financial problems, they are low risk. And only the majority who are in that space. And we've seen that it's mainly your micro lenders not complying with the returns, they're not filing returns on time, reporting on levies, failure to pay levies, and this kind of things. And also we have seen a lot of complaints from short-term insurance, and so on and so forth.
You've mentioned the one aspect, that being the pension funds, the collective investment schemes, and so on. I want to move the conversation to short-term insurance and medical aid funds and so on. What are the growth figures that you saw emanating out of the bulletin?
Okay, just repeat that.
I'm saying for the medical aids, the short-term insurance, and what are the trends that you saw emanate, or in terms of how they were growing for the review period?
Okay. So what normally happens is the growth because of the nature of their balance sheet, your short-term and medical aid. So by nature, they all have short-term obligations, unlike your pension in long-term insurance. So these guys, they tend to invest money for long-term purposes. So that's why naturally their growth rate is very high, because they invest in high growth assets, like your equities and so on. But the short-term space, predominantly more than 80% of their investments is invested in money market instruments. And you can imagine the growth rate of investing in money market instruments, which are very short-term. So naturally, you will expect very low returns, below, let's say, single digit. It cannot be double digit. So it's very much, if there's a growth in terms of investment returns, then it's very low. But maybe there's a potential growth, which at the moment we are still also trying to deal with that aspect, to differentiate between growth in new business and growth due to investment returns. So that's split. Normally, if the growth for this industry is over 10%, then you will know it's maybe because there was a lot of new business. But market returns, they are actually linked to your money market rates, like your treasury bills and so on and so forth. So that's how they grow. Not naturally below 5-7%, so they don't, if it's market related. But if it's higher than that, then we know it's because of new businesses.
How important are these statistics emanating out of the bulletin to the ordinary consumer on the street?
So the main important thing is actually to create awareness about, like I said, we want our consumers to know their right, and to be aware of institutions which are legally permitted to do business in the country. On the NAMFISA website, for all the sectors, we have a list of registered companies. The statistics are there. And they can also see which companies are not registered. That is the most important message, takeaway. Number two is also we have a complaints department. So the quarter under review, we resolved over 100 cases of complainants who came to NAMFISA to complain because they were not treated fairly. And out of these complaints, almost 80% of the cases which were reported to NAMFISA were resolved during the quarter under review. And with that, there was a refund or a reward in terms of capital or cash that was awarded back to the people who came to complainants, just over 300,000 Namibian dollars. So I think awareness around that is important, and also the awareness around how healthy are these financial institutions performing. They also need to look at the growth trends, the solvency, and all these statistics, because if these companies are not performing well, then they must be worried. And also in terms of our level of intervention, if you see that these companies are becoming risky, then the public must start to worry also. What is NAMFISA doing? They must start to question. So I think awareness about such things is very important. Then that way, that's why we are open and always transparent to disclose how we are doing, how we are progressing, and sharing this information to build confidence and trust to the consumers.
We are in Consumer Protection Month, or rather October has an emphasis at consumer protection. What are some of the key trends that you saw?
I think the key highlight there is what I mentioned about number of cases which were resolved. To be exact, 105 cases came through, and 79% of those cases were resolved, of which then led to an amount of over 300,000 Namibian dollars being awarded back to the consumers when the cases were ruled in their favor. So I think that is the big highlight in terms of cases, because consumers only come to NAMFISA when they have a problem. I'm sure we know some of the consumers who are not aware about this department existence in NAMFISA. I think they might just be sitting on their, whether they're in the village or wherever, lack of awareness also. I'm sure there are a lot of cases out there which can, that number could have been better.
Mm.
Yeah.
Your other function speaks to regulatory innovation, and one of the things that you're dealing with is the fintech square, is the regulatory sandbox, and so on. Just speak to us a bit about that end of your line of responsibilities.
Okay, so under the regulatory sandbox, there are two pillars. One is called the fintech square. That is a platform, a forum where we engage stakeholders, different stakeholders, be it the innovators, the general public, just to share information about innovation in the non-banking sector. So that is more an engagement forum where we engage with different stakeholders. And then the regulatory sandbox itself is a testing environment. So let me just make it clear. Normally, when one looks at innovation, it's a value chain. An idea starts with a research and development, and then when you have that research and development, people must ideally then go do research and then go to the incubation hub to develop their demos or prototypes. When that prototype is ready for the market, only then it qualifies to enter the sandbox. Because sandbox is a real-life testing environment where we allow innovators to test their new innovation or solutions in the non-bank. Example of solutions in the non-bank, like now we have started with a cohort for micro-lending. So digital solution in the micro-lending space, and then the next one will then speak to capital market, where we'll be looking at crowdfunding and peer-to-peer lending and those kind of things. So the sandbox is only to test products which are in the non-banking space and which are ready for the market. Then we now see, and we limit the environment. It's more like a pilot testing. If you come in, we don't allow you to reach out to the whole public. We just sign the testing agreement and put in parameters to limit your testing scope. Maybe instead of doing testing 1,000 customers, then we can now, in discussion with the innovator, then we come up with a reasonable number to reduce the exposure until the testing period is from 6 months to 2 years. So during that, we then assess how well the model is doing. Is it what are the risks emerging? How are the consumers being treated? How is the cyber controls and securities? Then we look at all these indicators in relation to the testing agreement, because the testing agreement is where we now define the key performance indicators. And then we monitor as the testing period is evolving. And then at the end of the period, then we now assess. Obviously, the assessment and discussion is ongoing with the innovator, but then the final decision is made at the end of the testing period to decide whether then to then give this company a go-ahead to be licensed, to then go full out to the rest of the public, or we then recommend an extension for more further testing, or we completely just reject and say, no, your model is not fit for the market. It's too risky.
Back to the fintech square that concluded quite recently. I believe it would be about over a month ago. What were some of the key outcomes that came out of that that you observed as Namfisa? So
the key outcome is actually an excitement from our stakeholders, especially the innovators, because we brought different speakers. There were master classes learning from the experienced entrepreneurs. So there were different lessons in terms of how to build a successful business, how to scale up, how to start, in a very prudent way or efficient or smart way, the benefits of collaboration and awareness about, startup risks. When you're a new business, there's what we call a J-curve. So the masters then gave lectures from experience to tell them how they navigated the storm, the valley of death. Some people call it the valley of death, some call it the J-curve. So for every startup, there's that natural V-shape. You go through that. So there was a lot of learnings from that perspective, and also they also had an opportunity to learn from the regulators, because on a bilateral basis during the exhibition booth, so there were also colleagues who had to learn from the regulators. I remember one of the innovators was dealing with an insurance product. So I brought an actuary to just explain to them certain things, how you decide pricing and so on and so forth, because they just put up a product and say, no, this is our price, but you cannot just put up insurance product without getting an actuarial input, for example. So there was a lot of bilateral learnings and networking opportunities for the colleagues.
For the budding entrepreneur, In terms of this FinTech Square, what are some of the engagements that NAMFISA is going to have going forward just to ensure that there's continuous learning?
So for that, internally we are taking stock. We have done a post-mortem, so we are putting our heads together. So one of the things that we are looking at is to do collaboration with institutions like your different hubs. Under the Namibia Investment Promotion Board, there's an initiative called Scale Up Namibia, the SUN initiative. So NAMFISA and all the hubs are members to that. So that is one channel we're looking at to then leverage some of their annual calendars rather than us reinventing the wheel, to just keep the momentum going, and then we can also just be present to some of those panel discussions or expos that they organize throughout the year. That is one. The second one is obviously to then do a thematic profiling, because NAMFISA have so many industries. So we then want to have that thematic profiling. You can say maybe this quarter we are focusing on insurance technologies, InsurTech, and the next quarter we focus on micro lending solutions. The other quarter we focus on capital market technology solutions. So we are still internally reflecting, but the idea is then to see how we can also spread our awareness, not only in Windhoek, but find other innovative ways to create awareness beyond Windhoek or outside Windhoek.
Thank you so much for joining us on the Business 7 show.
Sure, it's a pleasure.
Thank you for joining us on the Business 7 show. Hope to catch you again next week. Have a pleasant evening.